So for those of you who already had to ask budget or have a discussion with the board or your executive committee, you know what I'm talking about when I say that most of the time the discussion is rather frustrating. The frustration is on both sides. You have to get some pushback from your management asking you why you're asking for budget. And your CFO most of the time is also complaining that he's now investing since 2 years and you come again to ask for new investment, whereas the maturity has not evolved that much. So that's the kind of discussion that are usually happening. For me, when I had those kind of discussion, I'm not billed as Milos, obviously, so they don't even take me as the security guy from a physical perspective. In the best case scenario, they see me as yet another nerd from the IT crowd. But that's basically where the discrepancy is when we have those languages with the board. So the use case I'd like to present is how we can use knowledge, expertise, and processes from an insurance perspective to bring those discussions with the board in a language that they understand. And the language is not only into premium reduction, but also into discussing risk, presenting risk in a language the board and the financial committee can understand, and in the metrics that are also helping you to define loss and loss reductions. So I'm Sylvain Luiset. I'm head of cyber resilience for Zurich Insurance. And with my team, we help organizations, policyholders, and underwriters to better understand and manage the cyber risks. What we'll see is by explaining a bit quickly what is the insurance and how do we define risk, what at the end of the day, what it means for the policyholder, for the one having the premium. Insurance, when we think about insurance, the main goal of the insurance is basically to get an equilibrium. The equilibrium is between the premium and the claims, so the goal of the insurer is to make sure the premium is as low as possible. The goal of the insurer is to make sure that the claims are as low as possible, and the goal, in fine, of the insurer is to maintain this equilibrium between the claims and the premium. The picture you see at the bottom, that's one of the automate machines we have in our heritage center in Zurich. That's an automate from the 60s. It's basically a machine that is simulating one of the theory of one of the insurance mathematician, which is Zubler, which is basically putting the mathematics in all of this definition of the equilibrium. So basically, how much premium should we ask to make sure that we're able to cover all the claims? And if there is a bigger claims that is coming, are those premium able to basically absorb the claims? So that's the game of the insurance company, to balance the claims and the premium. To do so, we use multiple mathematical models. One of the models is one that is allowing us to define PML and EML. Those are two important metrics for us. The EML is basically the estimated. The PML is the probable maximum loss. It's basically the loss that you are going to experience when all of your controls are in place and all of your controls are working as expected. You can think of it a bit like you are on your desk, you have a glass of water, the glass suddenly bumped on the table, the water spills, but you have good reflex, you're able to catch the glass, you have some tissue aside, you're able to absorb the water, and in that case, maybe you have losses with your external hard drive being destroyed. That's the probable maximum loss. The estimate maximum loss is the loss that you would experience if all of your controls in place are deficient, not working as expected. Same situation, you have your glass falls on the desk, your reflex are not as good as usual, so you are not able to catch the glass, the water spills, your tissues are already wet, you cannot absorb the water destroys your external hard drive, your laptop spills on the floor, destroys your laminate. That's the estimated maximum loss. All of your controls are there, but for whatever reason, they are not working as expected. For the one of you that were in Zurich last Friday, we experienced an EML. We have water absorption system on the streets. They are supposed to work, but suddenly on Friday we had those 50-liter quantity per square meter. They are not designed to absorb that much. So a risk avoidance control becomes a risk mitigation control. Because of the wind, the leaves fall on the floor, they block those evacuations, and we have the flood. That's basically the worst case scenario because the controls were there, but not working as expected. So we take those two metrics in account, the EML and the PML, and we use that with another thing that we need to consider as an insurance company, which is our own risk portfolio. Sorry. So all of those policies that we have, for us as an insurance company, they also present a risk. It's called accumulation risk. The accumulation risk is basically one single event that will trigger multiple policies at once. We can think of it like the wildfire in Los Angeles, for example. It's one single event, one fire, but this fire is triggering multiple property policies at once. In cyber, we have exactly the same. That can be the WannaCry. The WannaCry is one single event triggering multiple policies at once. An attack, a cyber attack against the cloud services of Microsoft. That would be one single cyber event, but this cyber event will trigger multiple policies, if not all policies, of the ones that are using Microsoft Cloud Services. So we need to take all of those metrics in account when we get this calculation of the equilibrium between, once again, the claims and the premium. Very often we talk about risk, but what is risk exactly? As an insurance company, once again, we need to be able to define risk. And in Zurich, since now 150 years, we define risk as a combination of 3 different metrics, and we poetically named it the risk flower. So the risk flower is a combination of 3 different variables: the hazards, the exposure, and the controls. That's how we define risk. So when we have an event, the event will be influenced or designed with hazards. The hazard is what or who will harm a system. The exposure is the system that is at risk and losses that are associated to it. And the controls, those are all the measures that are in place to prevent, avoid, mitigate, or react against the risk. If I take an example, an event can be you have a hailstorm on top of your village, and the hailstorm is impacting your car with a category 3 strength. The hazard is a hailstorm. Each of the hailstorm will have a different capability. You have different size of ice cubes, and those will create different type of losses on your exposure. The exposure in that case is your car. Depending on the size of the hailstorm, then your car will be destroyed more or less. That's basically the losses that are associated to the asset that you have at risk. And finally, the controls, that's the measure you have in place to protect your car. You can have preventive control. You check every day the Meteo Suisse app to check if there is a hailstorm that is coming to your village, to know if you have to protect your car or not. You can have preventive control or protective control, which is basically you have an underground garage and your car is always under shelter. You have reactive control. You see that there is a hailstorm. You see that the hail is already starting to fall on your car, but suddenly you move the car somewhere else. Or you have avoiding control. You constantly drive away from the hailstorm. So that's basically the 3 components: hazards, exposure, and controls that are defining the risk for a given event. In cyber, we do exactly the same. The hazards, once again, are the what of the who. We can have cyber criminals, we can have script kiddies, we can have a malicious privilege administrator, we can have state nations. That's basically what will try to harm the exposure. Exposure, once again, it's your asset at risk with the associated losses. If you have an OT production plant, it can be business interruption losses. It can be incident response cost, forensic cost. If you have a database with CID data, the losses are also different. You have fines, you have potentially contractual regulatory liabilities, you have communication that you need to do, you have the Meldungpflicht that costs also money. So each of those different exposure will have a different loss category. And the controls, obviously, those are the measures that you have in place as a company to protect your organization. It can be a SOC, it can be a vulnerability management program, it can be a new SIEM system. That's basically what you control as a company to be able to have the impact on the risk. But at the end of the day, the risk, once again, is a combination of 3 different variables. When we combine this risk definition with our EML, PML, and accumulation model, we end up, or before doing that, actually, we use another thing, which is the FAIR methodology. So the FAIR methodology applies to cyber, and it's an international methodology that defines risk also in 2 different variables. One being the frequency of a loss event, the other one being the losses and the loss magnitude that are associated to it. In FAIR, it's very important to realize that it's not because you have a threat that you will necessarily have losses for your organization. If you face a ransomware but you have no losses associated to it, basically, why would you even care? So the whole idea of FAIR is to say you care of the risk only when the risk is a loss event, means you will have losses. If you only have a threat event, it means your company is at risk, but you don't experience losses. That's not so important in the equation. With those 2 things, the risk flower and the FAIR methodology, we now combine both, and we use our own risk flower to populate the input of the FAIR methodology. The hazards, that's what is impacting the system. Each of the different threat actors will have different capabilities and different probability of action. If we speak about one of the presentation before, they call it nicely kitten. Some of the nation states, they don't have the same threat capability as others. That's what we called the threat capability. How experienced and how evolved is your threat actor to start to harm your system? A system administrator, a privileged system administrator, he has potentially a lot of capability, but he has rather low probability of action, which is yet another metric that we use. So probability of action is you face a system, you are in contact with your data, you are in contact with the asset that you want to harm, but are you likely to act against this system? In order to act against the system, you also need to be in contact with the system. So those are the 3 variables that are used when we populate them with the hazards. We can think of an example once again with the disgruntled the system administrator. A system administrator with privileged access has a high contact frequency to a database with CID. But as long as he is not pissed off by his company, he has a low probability of action. He will not harm the system if he has no reason to do it. The capability of doing it are also depending on the administrator. He is not necessarily a hacker and will not necessarily have the possibility to act against the system, although he is facing it. So that's the hazards. Hazard is one part. The other part is the controls. That's basically your defense profile as a company. So as a company, you have controls in place. That's also a variable depending on the maturity of your control, and we input that into this FAIR methodology as well. And finally, the third one, that's the exposure. So it's basically asset at loss plus the loss magnitude of the different losses. And that's the other part of the FAIR equation. When we put all of this together, we simulate multiple scenario, multiple risk scenario. At the end of the day, it gives us the possibility to define risk in this financial metric. So when we speak risk with the risk flower on one side and the FAIR methodology on the other side, it gives us the possibility now to go to the board, to the CFO, and say, look, a ransomware, a risk for our company as of today with controls in place, is basically an amount of dollar. It's not a likelihood and a magnitude anymore, which are estimated from subjective scales. We now have this metric, which is financial term, which is also a language that the board is able to understand. The question is what it means for the policyholder and what the policyholder controls. The only thing that the policyholder can impact on those different variables, the exposure, the hazards, and the controls, are the controls. The policyholder has no impact on the hazards. The policyholder cannot decide how advanced is a state nation, how advanced is a script kiddies. Those are defined by cyber threat intelligence and by the cyber ecosystem. The loss exposure, loss magnitude, exactly the same. The policyholder does not define how much fines are relevant when the CIDs are impacted. The policyholder is not defining the liability from the contractual or from the regulatory perspective. He has to accept them. The only thing that the policyholder manages himself are the controls. At Zurich, we don't accept all the controls as being relevant or the control frameworks. It goes also in line with one of the previous discussion. We define some control frameworks as being recognized. It means fit for purpose. They are available and they are reliable. Those control frameworks, from our perspective, are the NIST, the CIS, the ISO. Those are control frameworks that we recognize as being good controls to assess. And as one of the other presenters said this morning, as long as you take one control and you stick to it, this control framework at least needs to be recognized. From an insurance perspective, we assess the controls of company. We do it in two different ways. The infamous cyber insurance questionnaire, usually also very painful for our clients, but that's the way we have as an insurance company. We ask questions. Maybe you don't recognize it when you answer the questions, but those questionnaires are also made with the NIST in mind. So basically, we organize the NIST in a way that is presented in the cyber insurance questionnaire. Cyber insurance questionnaire is a way. Another way is to do cyber maturity assessment. We also do it for our policyholders of our organization. And here we have a bit more of granularity and a bit more depth on the controls when we have the full maturity assessment for organization or for a policyholder. What it means for our use case. For illustration perspective, I took a company. It's a traditional Swiss small and medium enterprise. They do 13 million revenue per year. They have around 25 employees. They work in industry and manufacturing. That's our company. That's the policyholder that we need to assess and for which we need to evaluate the risk. We take the risk flower, we populate the risk flower with our data. The hazards come from the CTI. What have we seen for this specific kind of companies over the last 15 or 20 years? And that's the hazards that we will input in the equation. The events, we will simulate, in this example, a ransomware. We can do it for data leak. Once again, from an insurance perspective, we always care about business interruption and data leak. The ransomware nowadays combines in most of the time both. So for the example here, we take again the ransomware. The exposure, the asset at loss, we take it for this company based on our claims history, data insights. So for this type of companies, what are the different type of losses that we saw in the past? What are the most likely attack that they will have? In that case, it's a manufacturing company, so most likely OT, production, supply chain. That's the asset at risk that the hazards, the attacker in that case, cyber criminals will try to harm. And the controls, as I said, we have it from the cyber insurance questionnaire. We input that into our calculation. It gives us an EML, it gives us a PML, and it gives us the associated losses. The EML, the PML comes from our own methodology. The annualized losses for this company comes from the simulation between the FAIR methodology and the different component of the risk flowers. And what we see here is that this small company in Switzerland is likely to experience, for a ransomware from cybercriminal, a loss of 2 million or 2.5 million Swiss francs. Once again, illustration example, but it's just to give you an idea of the different metrics that we are able to give to policyholder as well as to the underwriters. That's the calculation of a risk. But it doesn't stop here. Someone said before, I think Milos, you said that when you go to the board, you need to discuss the premium. That's one aspect that the board is interested about, but it's not the only one aspect that you can discuss using this methodology. What I said is that the simulation is made between different variables. The hazard is a variable, the exposure is a variable, meaning that the controls are also variable. If we are able to quantify the risk as of today with control today, it means we can also simulate the risk when we improve controls in the future. If I give the example here for our small company, what we see is in the recover part of the NIST, they are quite poor. They don't have all of the controls in place. What we do, we take into account that this company will improve those controls, they will develop a BCP plan and the processes that are associated to it. They decide to go with a boutique company, usually costs around 25,000 Swiss francs. You mix internal resources and an external service provider. And then we run the simulation again, meaning that we can calculate the exact same as before, the PML again, the EML again, and the resulting outcome of the risk. And now what we see is the company is not losing 2.5 million anymore. The company is losing 2.25 million with this improvement of control. Which means now, using this kind of methodology, you can go to the board and speak not only premium reduction, but speaks also return on investment. With this investment in a BCP and a BCM processes, I ask dear CFO for another 25K, but it will give me a return on investment that will decrease my overall risk of a given amount of financial dollars. And that's what I wanted to present with those different things. So basically, how using the experience and the knowledge of an insurance company from the EML and PML traditional from the insurance, how we move to a new calculation of risk for cyber with this exposure and the FAIR methodology. We can now bring the discussion to another level when we go to the board. And I will use what, Milos, you were saying when you said, you need to talk to your stakeholder, you need to talk to the board, that's true, but you need to do it in a language that they understand, you need to do it on the same language. Thank you.